Smart money habits create wealth silently, without dramatic moves or sudden breakthroughs. Real wealth rarely begins with big wins. It begins with small, repeatable behaviors done consistently. The danger is that these habits don't look impressive at first, so most people ignore them. But over time, quiet consistency beats emotional intensity. For example, investing €300 per month at 8% annual return grows to about €55,000 in 10 years and €170,000 in 20 years. Nothing dramatic happened. No lottery, no viral success, just steady behavior. Most wealthy people don't feel rich while they are building wealth. They feel disciplined. Let's dive in. Paying yourself first changes everything. Wealthy thinkers treat savings like a non-negotiable bill. Paying yourself first means saving before spending, not after. This single habit flips your financial direction because it removes decision fatigue. The money is already gone, so lifestyle adapts automatically. If someone earns €2,000 per month and saves 15%, €300, immediately, they build €3,600 per year. Invested at 7%, that becomes roughly €52,000 after 10 years, without increasing income at all. Poor and middle-class habits treat saving as whatever is left, which is usually nothing. Spending is controlled emotionally, not mathematically. Wealthy people don't eliminate spending. They eliminate emotional spending. The difference is not how much money is spent, but why it's spent. Emotional purchases fade quickly, while intentional purchases compound value over time. A person who avoids €5 impulse purchases per week saves €25 weekly, or €1,300 per year. Invested at 8% for 20 years, that single habit turns into nearly €65,000, just by saying no to emotional spending. Poor money habits come from spending to feel better, not to live better. Lifestyle inflation is the silent wealth killer. Smart money habits resist upgrading lifestyle at the same speed as income. When income rises, most people instantly raise expenses. Wealthy thinkers pause. They keep life good enough, while income improves quietly. If income rises by €500 per month, and you keep €350 of that increase invested, that's €4,200 per year. At 7% for 15 years, that single restraint creates over €110,000, without sacrifice, just patience. Wealth grows fastest in the gap between income increases and lifestyle increases. Cash is a tool, not a goal. Wealthy people don't hoard cash, they deploy it intentionally. Cash feels safe, but idle cash loses value to inflation. Smart money habits keep enough cash for stability and move the rest into productive assets. Holding €20,000 in cash during 4% inflation loses €800 per year in real value. Invested at 7%, that same money gains €1,400 per year. The difference between fear and strategy is €2,200 annually. Poor habits confuse safety with stagnation. Time is treated as a financial asset. Wealthy thinkers respect time more than money. This is why they automate finances, simplify decisions, and avoid constant micromanagement. Automation protects consistency. If automation ensures you invest €400 monthly without fail, that's €4,800 per year. Missing just 3 years early in a 25-year plan can cost over €90,000 in lost compounding at 8%. Money can be replaced, time cannot. Compounding is trusted before it is felt. Smart investors stay consistent long before results feel meaningful. Compounding is slow in the beginning and explosive later. That delay tricks people into stopping too early. Investing €250 monthly at 8%, after 5 years you have about €18,000. After 15 years, it's about €87,000. After 25 years, it becomes 230,000 euros. The habit didn't change, only time did. Most people quit right before compounding accelerates. Debt is managed strategically, not emotionally. Wealthy people separate productive debt from lifestyle debt. High-interest consumer debt destroys compounding. Eliminating it is a guaranteed return. Paying off €5,000 credit card debt at 18% interest is equivalent to earning 18% risk-free. That's far better than almost any investment. Yet many ignore it because it's not exciting. Poor habits treat all debt as normal and permanent. Income growth is paired with skill growth. Wealthy thinkers invest in skills that raise earning power. Skills compound just like money. A small raise multiplied over decades changes everything. If a new skill raises income by €300 per month, that's €3,600 per year. Invested at 7% for 20 years, it grows to nearly €150,000 from one skill decision. Money habits alone can't compensate for stagnant income forever. Wealth is built on boring consistency. Smart money habits are boring, repetitive, and emotionally unexciting. Consistency outperforms brilliance over time. Wealth is built by showing up when motivation fades. Investing €500 monthly at 7% equals €6,000 per year. Over 30 years, that becomes roughly €610,000. No genius required, only persistence. That boredom is exactly why they work. Spending is aligned with values, not status. Wealthy people buy freedom, not validation. Status spending fades quickly. Value-aligned spending lasts. Choosing a €20,000 car instead of €35,000 and investing the €15,000 difference at 7% for 20 years results in about €58,000. From one decision, most people forget within months. Poor habits prioritize appearance over independence. Risk is calculated, not avoided. Smart money habits don't avoid risk, they manage it. Diversification reduces risk without killing growth. A diversified portfolio earning 6 to 8% beats cash losing 3 to 4% to inflation every year. On €50,000, that difference is €5,000 to €6,000 per year in opportunity cost. Avoiding all risk guarantees slow financial decline. Patience is a financial superpower. Wealth grows faster when you stop interfering with it. Constant buying and selling damages returns. Missing just the 10 best market days over 20 years can cut returns by over 50%. Staying invested matters more than timing perfectly. Overreacting is more dangerous than doing nothing. Wealth is measured in options, not luxuries. Real wealth gives you choices, not just possessions. When expenses are low and assets grow, stress fades. If monthly expenses are €1,500, reaching €450,000 invested at 4% withdrawal covers life indefinitely. That's freedom, not excess. Financial freedom is about control over time, not consumption. Quiet habits create loud results. Wealth is built before it is visible. Most people notice wealth at the end, not the discipline at the beginning. But the beginning is where everything is decided. Saving, investing, learning, and staying consistent may feel slow, until one day they aren't. The habits you repeat privately determine the life you live publicly. As we wrap up, remember this. Wealth is rarely created by dramatic moves. It is built through small, intelligent habits repeated quietly over time. The people who win financially are not always the smartest or the luckiest, but the most consistent. If even one habit from today's video changes the way you think about money, then you're already ahead of where you were before. We put a lot of effort into researching, structuring, and explaining these ideas clearly. So if you found value in this video, please like it and subscribe to the channel. Your support helps us continue creating thoughtful, practical content that breaks down money, investing, and long-term wealth in a simple, realistic way. In our future videos, we'll keep exploring smart money rules, real financial examples, and quiet strategies that actually work in real life, not hype or shortcuts. Thank you for watching. And remember, the habits you build today quietly shape the freedom you enjoy tomorrow.